Today on InvestTalk, we went over some strategies for your RMDs should you not need to use them immediately, answered live calls on Celsius Holdings, a question about what are some of the benefits of using institutional managers like KPP, and another question about SoFi, then ended the day talking about the Chinese market.
This is InvestTalk, independent thinking, shared success.
Now let's shift gears and talk about our main focus point today. Really start our main focus point today, and that is on strategies for RMDs, required minimum distributions. What to do when you don't need the money. And that's because legally speaking, after a certain age, you are required to start drawing down from some retirement accounts. And for a lot of people, for some people, that is fine because you do need the capital, but there are those people who do not need that. And so talking about reinvesting those proceeds, talking about utilizing tax-efficient investments like ETFs and other strategies can help those investors that don't necessarily need to draw down on that cash immediately. Understanding all of these options can show retirees how to align their financial decisions with their long-term goals and their tax planning. And so let's dive right in. For those of you who don't know, starting at age 73, retirees are required to make RMDs from their pre-tax retirement accounts like IRAs and 401ks. First deadline is April 1st after turning 73, and after that, it's December 31st each year. But for those who don't need the extra cash, there are some smart moves you can make. First up, reinvesting the proceeds. You can take your after-tax RMD and put it into a brokerage account. This allows you to continue growing your money, and when you eventually sell those investments, you could benefit from the long-term capital gains tax rates, which typically are lower than income tax rates. This strategy could lead to tax savings down the road, especially for big expenses like healthcare. Next, consider tax-efficient investments. Some retirees move their RMD proceeds into exchange-traded funds, also known as ETFs. Why ETFs? Well, they're incredibly tax-efficient compared to mutual funds because they usually don't distribute capital gains, which help reduce the tax hit every year. There's another option. For the philanthropically minded, there's a qualified charitable distribution, or QCD. If you're over 70 and a half, you can donate up to $105,000 directly from your IRA to a charity. This counts towards your RMD but doesn't add to your taxable income. It's a great way to fulfill your RMD requirement while supporting a cause that you're interested in. And by the way, it also helps you avoid triggering higher Medicare premiums or other tax issues tied to your income levels. The bottom line is, if you don't need to spend your RMD reinvesting or donating, those funds could help you optimize your finances while staying on top of your retirement goals. The US stocks were higher, a bit off best levels as the S&P 500 was actually set a fresh intraday high today. And that's coming out after a rally in Tuesday's session that saw the S&P 500 ended up almost 1%, erasing all of Monday's declines. The Dow finishing up 85 basis points today, the S&P 500 up 0.5%, NASDAQ up 35 basis points. Russell 2000 small caps up 40 basis points. Big outperformers today, software, cruise lines, investment banks, regional banks doing well. Big tech, mostly higher, extending those gains from yesterday. Underperformers, we already mentioned one of them during the show, China Tech. Industrial metals didn't do particularly well. Casinos, energy. And that's because crude oil was down 30 basis points. Gold and the dollar index, gold was down 30 basis points as well. The dollar index up 30 basis points. Overall, stocks added to yesterday's solid upside, though not much new around the broader market narratives. Despite today's backup in yields, there was some focus on dampened rate volatility, as well as the VIX continuing to come off of its recent highs. I would say other pieces of the bullish narrative seem to be some more soft landing optimism and improving economic growth outlook, positive seasonality heading into the end of the year, and really some guarded optimism around where Q3 earnings may be headed despite some downward revisions earlier in the quarter. And also there were some good surveys that suggested a resilient consumer heading into that holiday, as I mentioned. September FOMC minutes came out today and showed substantial majority of participants supported the 50 basis point rate cut, with almost all agreeing the upside risk to inflation had diminished pretty substantially. And that really led into some more Fed speak, which included Dallas Fed's Logan, who's a non-voter, said there probably a more gradual path would be appropriate heading forward, cautioning that inflation could get stuck back above the 2% target. But really, a lot of that upside seems to be capped from their perspective. Vice Chair Jefferson again today said the labor market noticeably cooling, and that is why that is their main focus. So that kind of reiterates what the Fed has been saying, which is we've shifted away from being more concerned about inflation, and now we are more concerned about the labor market. Still to come this week, CPI tomorrow and PPI Friday, though again with less of a focus on inflation. Unless there's a big surprise to the upside, it really probably won't factor that much into the Fed's decision-making process moving forward.
Hi, Justin and Luke. This is James from New York. I have a question about company NetEase, ticker symbol is NTES. They ran up a lot with a lot of the Chinese stocks that in the last week or so, but it's close to my buy range as it's coming down. I just wanted to know what you guys think of the company and what a good entry point is for this stock. Thank you so much. Have a great day.
The company is NetEase Inc. It is a sponsored ADR, an American Depository Receipt. Its ticker is NTES, and it's a $58-60 billion market cap company that primarily operates in China. You can see geographically 100% of its revenue right here comes from China. And that business segmentation is split between, I'd say, the old business, which is their games, and the new business, which is the cloud music, their innovative business, which is some educational services, and essentially ways they've been trying to grow and capture market share. Now, it did have a run-up with some of the China tech names. It's actually down about 5.5%, 6%. And today we'll actually talk about why later on when we talk about China. But overall, from a revenue growth perspective, it looks pretty solid. Its sales grew from about $10 billion in 2018 to about $15 billion more recently. Its margins have expanded pretty greatly from 9.2% in terms of net margin in 2018, all the way up to projected to be 27.8% this year. Now, its debt level is about $3 billion in debt on that $60 billion market cap company. It pays a 2.64% dividend yield, which for a lot of packaged software companies, you don't really see that. And the reason why this is an interesting company from my perspective is that what it does is it takes some of those mobile games that are played predominantly in the US, or rather a lot in the US and Europe, and essentially recreates them for the Chinese market. And so while I do think that this is a solid company, I am on the more hesitant side to invest in China right now, especially names that are primarily focused on Chinese consumers. I think there's a lot of issues within the Chinese economy. We'll talk again about them later on in the show. But either way, this has had a run-up over the past couple weeks as a result of floating and thoughts of Chinese stimulus, again, down again today, in the wake of some additional information. So given that they are 100% exposed to China, given that it is 100% exposed to Chinese consumers, I would have to pass on this name for now. Thanks for the call. Looks like we got our first live call. I love live calls. Let's go to Sid in North Carolina. Wants to hear about DIS. Do you own it or are you looking to buy it?
Hi, Luke. Thank you for taking my call. Yes, I do have 1% of my portfolio. I picked up at somewhere around $109, $110. So bit of 15% loss at this point. But do you think this is still a good company to add more, or I should just take a 15% loss? Please guide me through. Thank you so much for your time.
Yeah, of course. So taking a look at Disney, the Walt Disney Company, I think we all here know about Disney. It is one of the most storied companies in terms of brands, certainly, within the United States. And so they split between, their entertainment division, which has to do with their movies and their theme parks and all sorts of things that give a reach that essentially are just continued ways to sell their products to consumers. And when they started branching out into streaming, they didn't do particularly well, let's say. They were losing a lot of money. That's because there's a lot of streaming services. They're disparate streaming services. They're pumping out a lot of content. They spent a lot of money on acquisitions, on Star Wars, and pumping out Marvel movies, a lot of which started to fail now. And so for me, Disney is one of those companies that has a brand that is, frankly, unbeatable. And with that in mind, with them being able to suddenly potentially unlock more revenue from their streaming with sports collaborations with other companies on the horizon as well, them turning more and more to live sports with their theme park expansion that's going on, I think that what I'm seeing here is honestly a pretty compelling valuation. They're trading at 1.7 times price to book relative to their 5-year average of 2.5. They're trading at 18 times forward-looking price to earnings. They're trading only at 2 times price to sales. And over the past couple of years, they've gone from $52 billion in debt, in this most recent quarter, $47 billion in debt. So I think they're headed in the right direction. I think it is, again, is one of those unbeatable brands. So if you have the ability to hold it for the long term, I think Disney is a solid investment at this price. Thanks for the call. Oh, let's go to another live call. Art from Menlo Park, who has a question about SoFi. You own it or are you looking to buy it?
I own it, but I'm thinking about picking up a little more because because of the rate lowering of the rates, and it looks like they're getting more profitable in each quarter. So I was just wondering how it looks as far as that goes, and what an entry point would be.
Yeah, of course. Let's take a look at SoFi. So SoFi is a financial services platform. I think they were honestly one of the first to create student loan refinancing, personal loans within an app that is accessible through your smartphone. And they've been growing a lot over the years. Now, it's important to keep in mind they are certainly far, far, far down from their 2021 high, where they were trading at about $25 a share. Now they're trading for $8.59 per share. But I would say one of the benefits of this company is that they have been growing pretty quickly. Their revenue up from $600 million in 2018 to about $2.912 billion last year, though that is supposed to fall to $2.4 billion this year. Now, it is true with falling interest rates, there could be a boost to, or rather an expansion of SoFi's business. That's something that we certainly like. Now, it's a $9 billion market cap company. It's got about $5.3 billion in debt as the end of last year. And that had them pretty leveraged. They actually had an interest coverage ratio of 1 times, meaning their earnings before interest and taxes could only cover their interest expenses 1 time over. Now, they paid down their debt a little bit. They only got $3.2 billion in debt now. But I think for me, my issue is that they're still trading at 37 times forward-looking earnings. They're still trading at 30 times price to cash flow. They're a financing company that is trading over their book value, the industry average at 1 time. So yes, I think interest rates falling can be beneficial to this company in terms of expanding their loan book, but I think that they're currently a little overvalued. So overall, I think they're headed in the right direction in terms of paying down their debt. That is something they absolutely needed to do. They're projected to be profitable for the first time this year and projected to make 11 cents a share this year, 26 cents a share next year. But overall, I think they're a little overvalued. The market looks like it agrees with me. They have 18% short interest out there right now. Thanks for the call. 3 live calls in a row. It looks like you guys don't want to hear about the market today. Now let's go to Randy in Rancho Cucamonga, who has a question about high returns.
Yeah, well, Steve once mentioned that he gave some money to KPP Financial, and they always were able to outproduce his returns. So he became an intern and wanted to learn how to do it. So I don't know if you've heard that story before, but what are the inherent advantages that your firm has that individual investors don't have?
Yeah, well, if you're watching at home, you're looking at it right now, which is FactSet. And that is one of many tools that we use. It's one of many tools that a lot of institutional managers use. And the problem is there's a high barrier for entry for institutional managers compared to retail guys like yourselves. And that's because this tool, one license for this tool costs about $20,000 a year. If you go into Bloomberg, that's another $35,000 a year. And so when you're managing portfolios, when you're researching, data is the most important thing that you have at your fingertips. And unfortunately, a lot of times it is paywalled, if you will, behind these high exorbitant licenses. And you can certainly get a lot of information on securities. You can get a lot of data on a lot of things as a retail investor for, a couple $100 a year. But the speed of data, the ubiquity of data, the full access of data within platforms like the ones that we use, like the ones that other institutional managers use, not only make it easier for us to react to market changes, but make it easier for us to keep an eye and realize new investment opportunities quickly for our clients. I think honestly, that is one big benefit. The other is frankly scale, right? We get better trading costs. We get better prices because we are an institutional trader versus retail investors. It's honestly just the way the business works. There's a lot of things that make it easier for institutional managers versus retail guys. It's unfortunate. I think it's a little unfair, but that's how the business has evolved over time. Hope that answers a little bit of that.
Well, thank you.
Yeah, have a wonderful day. Justin and I always ask for live calls, and I've thrown down the gauntlet today, and you have responded. Let's go to Santaj, who has a question about CELH. Do you own it, or are you looking to buy it?
I actually own a few stocks. Just wanted to check what's going on. Should I take in some losses, or should I hold on to it?
Yeah, of course. So CELH is Celsius Holdings. For those of you who don't know, Celsius Holdings is a drink distribution company. And so one of the things that you may know about Celsius Holdings is the Celsius drink itself. And it's actually down 44% year to date, down 42% on the 1 year. It's up 6% today, but either way, the clear trajectory of this name is down. Now, one of the reasons why I would say is because it is a serial diluter of shareholders. They are up from 200 million shares in 2020 to 235 million shares today. About 12.8% short interest out there. Now, I'm going to make this one really easy. I think the issue with this company is it had a lot of revenue growth early, right? From 52 million in 2018 all the way to 1.3 billion last year. And it's not growing much this year. And the reason why is because this is a very bloated industry and there is not a big moat for this company. And so it had a lot of hype. It had a lot of influencer advertising, which pushed its brand, but growth has really slowed. And so for me, honestly, I think there are better investment opportunities out there. Look, from May, it's fallen from almost $100 a share all the way down below 30. It doesn't look like it's found any support. Again, I think people too often think about getting close to their money back or where this thing is going to bounce. And yeah, it may bounce a little bit, but you got to think about the opportunity cost of having your money elsewhere. So overall, I think, again, this is a company that doesn't have much of a moat. Growth is slowing. I really just don't like its prospects that much moving forward. Thanks for the call. This is InvestTalk, which means we need to pivot back to the voice bank for a question that came in earlier on 888-99-CHART.
I was hoping you guys could give your opinion on Primoris Services Corporation. The ticker is PRIM. I've been looking at it now. I think it looks good, but looking to see if you guys can give your own opinion. If you guys do think it looks good, if now's a good time to buy, or if I should wait for a pullback. Thanks again, and we'll listen on the show.
So Primoris Services Company, that is ticker PRIM, is a construction, maintenance, and engineering services company that operates primarily in North America. And they actually have a lot of exposure. They send a lot of crews to start helping in disaster areas as well, which certainly, given what is going on in parts of this country, is an important thing to note here. Now, it's a $3.2 billion market cap company. It has about $1.3 billion in debt as of the most recent quarter. And since 2022, its cash flow has been improving pretty solidly from negative territory back into positive territory. It dipped into the negative in 2022. Now, its profitability has been pretty flat over the past 5 years. I would honestly say surprising, especially given what has happened to the industry as a whole. And it looks like from a short interest perspective, it's fairly minimal, about 1.8%. Earnings per share has been improving pretty solidly, actually, since 2019, from $1.61 per share, projected to be $3.34 this year, and then $3.84 next year. Let's look at its revenue. Its revenue has grown from about $3 billion in 2018 to projected to be $6 billion this year. And honestly, that growth trend line has been falling, but it's still pretty significant, 14% over the past 5 years. Now, it's trading pretty expensive, in my opinion, for a construction company. 16 times forward-looking price to earnings, 2.5 times its book value. It's certainly at the upper ends of its range, and you can see that in its relative strength. It has never been higher over the past year. If you see its chart, it is pretty much just straight up and to the right, although it had consolidated a little bit from May until September. I think overall, the growth here is pretty solid. I like its debt levels, or really its lack of high debt for a company in this particular industry. It pays a modest dividend, and it's paid that dividend for the past 5 years. Its dividend per share, spot on, 24 cents per share every single year over the past 5 years. Again, I like it. If you see where its target price is for the brokers that cover it within FactSet, it's about 62 where it is right now. I think it's a solid company. It still looks a little overvalued to me. It has had a recent price spike from about the $50 per share level up to $60 per share. It's trying to find some resistance. I would keep it on my watch list for now. Certainly, in my opinion, trading around 2.5 times at the upper end of its 5-year range in terms of price to book value leaves it on the kind of expensive side. Thanks for the call. I hope you've been telling your friends and family members that our InvestTalk audio podcast is also available in video form on our InvestTalk YouTube channel. And when you head over there and when you watch us do this show and you leave a question in the comment section, we like to get to those. So let's get to one right now from Selena Marie, 6220. The question is about ticker HSTM. And it says, what are your thoughts on HSTM? What would be a good entry point? Let's pull it up right now. HSTM is HealthStream, and HealthStream is a packaged software company. And what it does is it provides software solutions for task management, training, learning management, workforce development, and also patient management systems. As you can see, the workforce solution is about 100% of its revenue, or exactly 100% of its revenue. That is their only business segment, and geographically, 100% of its revenue comes from the United States. Now, what strikes me at first is the lack of growth here over the past 5 years, especially in a time when a lot of companies have been reinvesting in workplace systems. And that has also been the case within the healthcare space. So it's kind of surprising that they only have about a 4% annualized growth rate over the past 5 years. Now, in terms of its net margins, they've been stable, 5.7% in 2018, 6.1% is where it's projected to be this year. The company has pretty much no debt. Though it is a very small company, it's just under $1 billion at $876 million. But regardless, they have pretty much no debt, $19 million in debt, negative net debt because they have $83 million in cash. Their earnings have been on a pretty solid trajectory since 2021, though it is important to note that they started buying back shares in 2020. So from 32.5 million down to 30 million in 5 years, which means that artificially, right, their earnings per share is going to go up because even if their earnings doesn't go up, their shares are going down. Now, in this case, it looks like their earnings overall have been increasing, though slightly, from 13 million in net income in 2018, projected to be about 16 million this year. What about the relative valuation? 47 times price to earnings, 2.5 times price to book, price to sales, 3.1 times price to cash flow, 13 times. Price to earnings is a little bit expensive, but it's not the be all end all of things, right? We're looking at a whole bunch of things here. In this case, their price to book, price to sales look pretty reasonable to me. Honestly, I'm not getting really excited here. And the reason why I'm not getting excited is because cash flow has been pretty stable. Profits have been pretty stable. I like that they're buying back shares. They pay a little bit of a dividend that they started paying in 2023. And their payout ratio is about 20%. So, they have a lot of room there. It's likely to continue going forward, but honestly, what I'm seeing is just a ranging chart with not a lot of growth. I think there are probably better opportunities out there. Again, in a time when a lot of companies are spending on workplace solutions, it's surprising to me that there has not been a lot of sales growth. So for me, if I'm going to hold a company that is asymmetrically exposed to the risks of being a small cap, I want one that's growing a lot bigger than this, a lot better than this. Thanks for the comment. Now, I want to talk a little bit about the Department of Justice. And that's because the US DOJ has proposed what they call remedies to weaken Google's dominance in the search market. And that could really shake up not just the tech giant's business, but the industry as a whole. On Tuesday, the DOJ outlined several measures aimed at curbing Google's alleged monopoly in online search. These include a potential breakup of key businesses like the Chrome browser and Android operating system, which have been pretty critical to maintaining its grip on the market. DOJ is also considering rules that could prevent Google from collecting user data or even force the company to share its search results with competitors. These proposals could hit Google right where it hurts, honestly, in their core search business, which has been a massive profit engine and really the source of their dominance for decades. Analysts warn that forcing Google to share data with rivals or stop collecting it altogether could erode its competitive edge. One of the biggest concerns, I would say, for Google is how these remedies from the DOJ might impact its advancements in artificial intelligence. They're already feeling the heat. They're already falling behind from competitors like OpenAI with their partnership with Microsoft, the maker of ChatGPT, and other AI-powered search platforms like Perplexity. With the US search ad market share forecast to dip below 50% by 2025, the last thing Google really needs is regulatory restrictions that could hamper back revenue that is likely going to be falling already. And so the DOJ's plan is honestly a pretty sweeping effort that could fundamentally change how Google operates, but there is a lot of uncertainty. If you recall, decades ago, the DOJ tried to break up Microsoft. That didn't ultimately happen. Why? Because some of these proposals tend to be far broader than the courts will allow. They're more ambitious, and they could struggle to survive the legal process. And so as Google faces a range of antitrust challenges, including its recent ruling against its App Store, the company's share price is dropping. And that's because, well, there is a lot of regulatory risk on the horizon. But if you're talking about a breakup of Google, you would expect a further drop than what you've seen. And so that kind of hints that investors in the market seem skeptical that a full breakup will actually happen. And so while the DOJ's proposed remedies aim to break up Google's search dominance and create more competition, the outcome is definitely far from certain. And Google's ability to maintain its position both in search and what that means for its development of AI will really have a lot of effects going forward on what the company will be worth.
This is Jason from New York, calling about AstraZeneca, symbol ACN. Bought it a couple years back. Just looking to see your thoughts on the future, whether the stock might be a hold or sell. Look forward to hearing your answer on the podcast, and thank you for all you do.
Sure. So AstraZeneca is a pharmaceutical company. One of their biggest products is a medication used in the treatment of type 2 diabetes. And overall, fundamentally, from a balance sheet perspective, the company looks to be in pretty good shape. It's got a market cap of $238 billion, about $33 billion in debt. It's important to note that is an increase from the end of last year. But honestly, nothing crazy, right? If you're operating at 6.4 times your interest coverage ratio, you're not overly levered at all whatsoever. Now, in terms of revenue growth, 15% on an annualized basis. Going back to 2018, $22 billion in terms of revenue, projected to be $52 billion this year. That is more than double where they were in 2018. Excuse me. And so I would say that overall, top and bottom line growth looks pretty stellar. Their net income has increased 22.5% on an annualized basis over the past 5 years. Their net margin has gone from 9.8% to 24% is where it's projected to be this year. Their cash flow has gone from about $4 billion in 2020 up to almost $12 billion this year. And like a lot of pharmaceutical companies that are mature, they're developed, they pay a pretty solid dividend. And the dividend's been increasing, $1.37 per share in 2018, $1.55 per share is what it's projected to be this year. And it's had a pretty decent year. It's up about 15% year to date, but I don't think that means it's anywhere near overvalued. Forward-looking price earnings 16 times. Its 5-year average is 18 times. It's price to book about 6 times. Now, for pharmaceutical companies, you tend to see that be a higher number. Why? It's kind of difficult to, from a book value perspective, capture some of those patents. And right, pharmaceutical companies operate primarily on their trademark drug patents. So overall, what I'm seeing is a company that is fundamentally sound, a company whose profits are increasing, a company whose efficiency seems to be increasing as well. And so, I think that it has been, it's been pretty dominant within the pharmaceutical industry over the past couple of years, and its prospects heading forward, it doesn't seem to me like it will be anything other than dominant as well. Let's dip back into our InvestTalk YouTube channel question bank. This question from Carter Erickson says, I'm thinking of buying GL. Do you think it's a quality company? And where would a buy point be? Well, GL is Global Life, and Global Life is an insurance company. They offer life insurance, annuities, supplemental health insurance products. They're a $9.3 billion company with $2.2 billion in debt, so not too much debt. Their earnings per share has been on a solid trajectory since 2021 from $7.22 per share to $10.07 last year, projected to be almost $12 this year, $13.27 next year. Now, again, as with one of the companies we were talking about earlier, it's important to note that they have reduced their shares outstanding from 110 million to 90 million. And so in terms of their actual earned income, it looks like it has been improving, which is pretty, it has been improving from 702 million in 2018 to about 971 million in 2023, projected to be over $1 billion this year. Now, it's important to note with this company, it has had a rough year. There's a significant drop after one of those shorting firms. I won't name the shorting firm, but there are firms out there who short a stock, they drop research, and then the stock price tends to move, and we find out if the research is accurate, whatever. So there's a pretty solid drop down to the 80 level. It has since rebounded, trading for about $100 per share, but regardless, it's still down almost 12% this year. And so we talked about how insurance companies work before, and we understand that one of the ways to generate revenue is taking on increased risk. And so as with any insurance company, I think I would need to see where a lot of their policies are concentrated, but keeping that in mind from a relative valuation basis, it's still on the low end on the heels of that research report. Its price to book is about 1.8 times. That is at about its 5-year average. I think it seems like a pretty fairly valued company. But anytime one of these short firms come in, and this was in Q1, they came in and set a price target of about 64 that caused the drop off here. It does bring me to pause. Now, there was also a notice of action from the federal government on from the Equal Employment Opportunity Commission. So again, this is, for me, there's a lot of things going on here. It's one of those questions where it's difficult to answer in this format and give you a thumbs up or a thumbs down. I would say for this name, anytime I get a name in a question that has a lot of things I have to dig into, I tend to say, well, if you want an insurance company, if you want this kind of company, maybe look elsewhere. There seems to be a lot of baggage specifically for this year. And without being able to dive into it deeper, I can't honestly say if this would be a thumbs up for me. So I can say, maybe look elsewhere because it's a lot of baggage. Thanks for the comment. Now, before we head off for the day, let's talk a little bit about China. And there's a recent sharp drop in Chinese stocks after investors were left pretty disappointed by Beijing's lack of detailed fiscal stimulus plans to boost the economy. On Wednesday, China's benchmark CSI 300 index fell 7.1%, its biggest one-day decline since February of 2020, as expectations for significant fiscal boost failed to materialize. Investors have been anticipating major spending to follow recent monetary easing measures designed to support the country's struggling stock and property markets, and they've been struggling for quite some time. Now, the head of China's National Development and Reform Commission, the NDRC, announced some economic support initiatives, such as front-loading 200 billion yuan, about $28 billion, from next year's budget for investment projects. However, these measures didn't include the broader fiscal stimulus many were hoping for, and a lot of people expected, and so, as such, stocks kind of tumbled. Investors had expected a bigger financial injection, particularly after September's Politburo statement promising stronger economic support. Now, it's likely the case that China is focusing on stabilization rather than expansion, and that's probably well advised. There's still hope that more substantial fiscal measures could come soon and could be on the horizon, with many looking ahead to a finance ministry's briefing scheduled for the weekend. Over at Citi, they estimate that a reasonable fiscal package could total 3 trillion yuan aimed at supporting local government revenues, consumption growth, and potentially stabilizing China's smaller banks. But for now, we're going to have to wait for all of that. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads, which you and they can get at iTunes, Google Play, and Spotify. Please be sure if you stop on over at iTunes to leave us a rate and review. I hope you've been telling your friends about our InvestTalk podcast program. It's a great place to leave a question in the comment section, and we'll get to those as soon as we can. Just remember, it's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.